This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading breakouts. I want to talk about bear breakouts today. I want to move on and talk about stop management. And finally, I want to talk about how to enter the trade. This is a 5-minute chart of the dollar versus the Canadian dollar. And we have a parabolic wedge up, a tight channel with 3 or 4 pushes on it, and a reversal down. At some point, after 3 or 4 or 5 bear bars closing on their lows, you have to assume the market is always in short and that we'll get at least a small second leg down. If you want, you can call this a bear breakout below a bull channel, or you can simply call it a reversal. Big up, big down. Take a look at the close of this bar. At the instant that that bar closed, if you had 2 choices, either to buy or to sell, which would you do? Let's say you were going for the same size profit target for the buy or sell, and were willing to have the same size risk, the same stop distance. Let's say you were to sell, and your profit target is here, a measured move down based upon the height of the breakout, and you put a stop just above the breakout. Or alternatively, you chose to buy with a stop, a measured move down, and you target the top of the breakout. For the bulls and the bears, the stop is the same distance, the risk is the same, and for the bulls and the bears, the profit target is the same as well. The risk-reward ratio is the same for the bulls and the bears. What's different? Probability. After so many consecutive bear bars closing on their lows, the probability favors the bears. So if we're going to go this distance, it's probably going to get that distance down before it gets that distance up. To say that you believe the market is probably going down means you believe there is at least a 60% chance that the market will come down here before it gets up there. And therefore, you have to sell. If you have a reward equal to your risk and you have a probability greater than 60%, you can exit with a profit equal to your risk. And that means if you sell here, exiting at 1 times your risk down here results in a positive trader's equation. Therefore, it's okay to exit with a reward 1 times your initial risk. And this is what happened. At the bottom of the parabolic wedge, we got a bounce, a couple legs up, 2 or 3 legs up, and then a lower high major trend reversal and trend resumption down. The bears would have been a little bit nervous after a pair of good bull bars closing on their highs, but experienced bears would look at this and say that it's probably a buy vacuum test of a 50% pullback, and therefore it probably is a bull trap. Even at this point, the odds still favor the bears. Again, the risk and reward are the same for the bulls and bears, but the bears have a higher probability. Whenever you see the start of a breakout, you need to be looking for signs to let you know how strong the breakout might be. Remember, a single bear trend bar is a sell climax and it's a breakout. Sometimes it grows to 2 bars, sometimes it grows to 6 or more bars. This sell-off is a breakout, and at some point you have to decide whether or not it's strong enough to get short. You have a series of big bear trend bars, big relative to the bars to the left. They're good size, and they're all closing at or near their lows. After you've had 3 of them, the odds are the market's going lower. Consecutive strong trend bars, that's a sign of a strong bear breakout. Close on the low or small tails only on the bottoms of the bars, another sign that the breakout is strong. Context, lower prices. We're getting a reversal and we have a strong reversal down. As I said, you can look at it as either a reversal down or as a bear break below a bull channel. The chart has about 100 bars on it. If you remember what I said about the market cycle, only about 10% of the bars on any chart are in a breakout phase. Most breakout attempts last only 2 or 3 bars and do not result in a breakout. They result in a continued trading range or a reversal. Only 5% of the bars on any chart lead to a strong trend, and that is the case here. 6 bars out of about 100. If you were to look back at more days on this chart, this is the parabolic wedge rally here. This is the reversal here. Here's the reversal down. And to the left, the market was in a triangle. This is the prior trading. We have a parabolic wedge breakout above a triangle, and the breakout failed and reversed down strongly. Another reason to expect at least a second leg down. It's good if you can decide early that the market is clearly always in short. Consecutive bear bars, big bear bars closing on their lows. It's a strong bear breakout. You have a parabolic wedge breakout, and if you saw the left, there was a triangle here. So it's a bi-climax breaking out of a triangle, and now it's starting to reverse. In fact, after just 2 or 3 bear bars, you know the odds are we're going at least to the bottom of the bi-climax. Strong follow-through selling. We have a bear break below the parabolic wedge and a good follow-through bar. After 2 or 3 bars, the market is clearly going lower. And there are many ways to sell. You have to decide which one. All you know is you have to get short. It doesn't matter how you short. If you sell at the market, sell the close. Any short anywhere through here has the same stop, above the top of the bear trend, or possibly just above the top of the sell climax, which is just below that. It's so close, I would pick the wider stop. It would have a slightly higher probability of leading to a profitable trade. Let's say you just decide to sell at the market, and that's okay. You see the market going down. At some point here or here, you know it's coming down here at a minimum, and a reasonable thing to do is just sell at the market and use the appropriate stop and have an appropriate position size. The stop is about 40 pips away if you sell here, and you have to make sure that the position size is appropriate for using a stop that size. Some bears will press bets. That means they'll add to their winning position. If they sell here, they might sell on a stop just below here. Chances are, once we get to the bottom of the parabolic wedge, we're going to get a bounce. However, some bears will sell for any reason. Let's say they sold up here, and they'll sell more on the next sell signal, the bear break below the bottom of the parabolic wedge. You can sell the close of any of these bear bars. And when I say sell the close, there are several choices to do it. One is right before the bar closes, you can see it's going to be closing near its low. You hit sell the market, and you'll get filled during that bar right around the close. An alternative is you wait for the bar to close, and you hit sell the market, and then you get filled on the open of the next bar. Another way is you wait for the close of the bar, and then you place a limit order to sell at that close on the next bar. For example, if you did that here, you place a limit order to sell at the close of this bar. As soon as this bar opened, it went above that close and you would have been filled. However, if you did that here, if you placed a limit order to sell at the close of this bar did not get above that bar's close and you would not have been filled and you would have missed a strong sell-off. In general, it's either better to just sell at the market right before or right after or just as the bar is closing, and then use the appropriate stop. Another choice is we have a strong breakout below a bull channel. You can sell a low 1 bear flag or a low 2. We went up here, low 1. This is a low 2. And this is a bigger first leg up, pull back, and a bigger second leg up. So this is a bigger low 2. And it's also around a 50% pullback of the initial sell-off. Now, instead of selling below the low of the prior bar, betting that the reversal up will fail and that the reversal up will become a bear flag, You can also sell above the prior bar, also betting that the reversal up will fail. For example, we have a failed low one here. You can sell at the high of this bar and get filled here, or you can sell at a prior high at the high of this bar and get filled here. Here we have an II after a bull breakout, but it's a second leg up, one pullback, two, around a 50% pullback. It's reasonable to sell above the high of that bull flag, betting that it'll fail and be followed by a resumption of the bear trend. Another choice is you look at this and say, okay, this is probably a lower high and a bear leg in what will become a bear trend, and therefore I want to sell strength. Anytime the bulls look good, I'll sell. For example, we have consecutive bull closes, but as I said, 50% pullback from the initial sell-off and two legs up. It's reasonable to sell the close of that bull bar, betting that the market's not going to reverse up again. We went up strongly. We went down strongly. Chances are we're not going to go up strongly. We'll get a lower high and a test back down. So if you see a strong bull bar, it's a reasonable sell. Just sell at the market. When you're in a strong breakout, the market tends to spend a lot of time at the low. At any given instant during this sell-off, the market is spending a lot of time right near the low. It's not giving you an opportunity to sell pullbacks. Beginners are always worried about risk. They're always worried about blowing their account. They're worried about losing so much money in their account that they'll no longer have enough margin that would allow them to trade, and that could result in the death of their dream as a trader. Plus, it'll get their husband or wife mad at them, and they don't want that either, and they don't want to feel like a failure. The problem with beginners is all they see is risk. They know they should sell here. They know they should be selling anywhere in here, and they look up here and they say, oh my gosh, the stop is too far. I don't want to risk that much. I better wait for a pullback. And the result is they end up missing the entire bear breakout. And when they finally get a pullback, they look at it and say, oh, I can't sell now. The market's reversing. And they end up not selling the bear flag. For experts, they see lots of reasons to enter. They can sell any of these closes. They can sell the low one short. They can sell above bars. They can sell strong bull closes. They can sell, again, resumptions going down. They're going to sell one of those ways. Some experts will sell early and then sell more as the market goes down or on a reversal back up, scaling into a winning position. If they sell here and they sell more here or here, any of these sells, they're adding to a winning position that's scaling into a winning trade. And those bears are confident that as they saw the bear breakout increase, the probability that this reversal up would fail becomes higher and higher. The stronger the bear breakout, the less likely the reversal up would succeed, the more likely it would become a bear flag and lead to lower prices. I think stop management is very important. Beginners tend to use stops that are too small, and that causes them to lose money. There's never really a good reason to miss a trade. Once you feel anxious that you're missing the trade, you have to sell. Just sell for any reason. Sell closes, sell at the market, sell bear flags, sell reversal attempts up. You have to sell. And it doesn't matter where you sell. If you sold on a stop below this bar, sold any of these closes, sold any part of this rally, guess what? The stop is the same. It's right here. Your stop has nothing to do with the price you enter. The stop has simply to do with the price action. And usually, if you're having any kind of a strong trend, the stop goes above the top of the trend. By the close of this bar, everyone agrees the market's going lower. The market's always in short. And the stop is above either the top of the bear breakout or the top of the bear trend. With them being so close to one another, I would simply put my stop above the top of the bear trend. Both are reasonable stops. And if you have two reasonable stops, it doesn't matter which one you take. If you take 100 trades, the tighter stop will lose more often. The wider stop will lose more when it does lose. But after 100 trades, the profit will be about the same. The key is knowing whether or not the stop is reasonable, and it's usually pretty clear where a reasonable stop is. Again, once you decide that the market is going down and you're waiting for a pullback to sell, or if you're waiting for any reason to sell, and you're waiting more than a bar or two, just sell at the market and just use the appropriate stop and trade small, even trade very, very small, but you have to sell. Is this a major trend reversal? We have a bear trend, we have a breakout above the bear trend, and we have a higher low. No, it's not a major reversal, it's a minor reversal. The pattern is too small, and therefore this is not likely to reverse this trend, and probably the best that the bulls get is a trading range. The market's still always in short, and it's probably going to remain always in short unless it breaks above the top of this strong bear trend. It can become always in long if it has maybe 3 or 4 big bull bars just before it gets above the high of this bear trend, but without that, you have to assume any reversal up is minor, and it will become either a bear leg in a trading range or a bear flag leading to a resumption of the bear trend. Let's say you shorted for any reason, and then you see consecutive bull bars like this, or a failed low 2, 1, 2, and a rally and a decent bull bar. It's okay to exit your short, although it's not ideal. But if you're able to sell again on a resumption of the bear trend, then you can take your trade off. But if you find that you exit either above here or above here, and then do not sell again, you should not be doing that going forward. You should only exit if you still believe the market's always in short and it has not hit your stop. You should only exit if you have the ability to get short again. If you find that you exit and never get short again, then don't exit. Just rely on your stop. Here we have a wedge, 3 legs up, 1 or 1, pull back, 2, and then down again, a doji bar, and then up again, 3, and then down again, and then 4, and it's around a 50% pullback. So we have a wedge lower high after a strong bear breakout and around a 50% pullback. This is probably going to result in a second leg down, and therefore it's better not to get frightened out of your short position. If you do exit for any reason, you have to look to sell again, either below this bull bar because of the wedge and a 50% pullback, or bear close, or above this bar betting that it's a bad looking double bottom. It's a doji after a big bear bar, plus it has a bear body, probably sellers above, or on the resumption down, either below this bull bar or below that bear bar. Sell for any reason. Lots of choices, just like there were many choices for selling over here. The market's still always in short, and it's still on a swing trade, and this strong bear breakout probably is going to result in a measured move down. Again, strong bear breakout, many ways to get short. Many choices for the stop as well. Some traders don't want to use the stop all the way up above the top of the bear trend. Instead, they want to use a money stop, like 10 or 20 pips, or they might decide the risk is too big and they want to get out just above a 50% pullback. So they might risk maybe 5 pips above a 50% pullback. The best stop is above the top of the sell climax. It doesn't matter where you sell, here, here, or here. That is the best stop. Again, you could put the stop simply above the top of the bear breakout, but it's so close to the top of the bull trend, I would risk the additional few pips. Now, what about putting a stop above this bear bar, arguing we have a 2-bar breakout and then very good follow through from there? Probably the market's not going to get back up here. And that is true, but the tighter the stop, the lower the probability that you'll have a profitable trade, the more often you get stopped out. Wider stops, you lose less frequently, but when you lose more money on that trade. Again, these are all reasonable stops. If you use any reasonable stop, your profit profile after 100 trades or so will be about the same. I said reasonable stop. These are reasonable stops. If you sell for any reason, can you risk just 2 pips? Is that reasonable? No, you're going to lose 95% of the time. Or if trading a 5-minute chart, can you risk 500 pips? No, that's unreasonable as well, because if you're entering on a 5-minute chart, you're probably looking to enter at the end of the day, and the market's never going to go 500 pips. It could easily reverse 50 pips against you, become always in long, in which case you should not be holding short. But if you have a stop 500 pips away, there's no stop at all. These are unreasonable, and if you use unreasonable stops, you're going to lose money. If you use reasonable stops and get out appropriately, the odds are very good that you're going to make money over time taking enough of these trades. Some traders prefer high probability. They use wider stops. Other traders prefer smaller risk and they tend to use tighter stops. But as long as the choice you're making is reasonable, it doesn't matter which choice you choose. You have to be happy and comfortable trading, and as long as you can take a trade and pick a stop that's reasonable and be comfortable taking the trade, you should do that. These are all reasonable shorts, and it doesn't matter which one you take. Again, the stop is still the same. Strong bear breakout. Let's say you sold finally down here, the very worst close of the entire sell to close bear trend. The stop is still up here. Every time there's another strong bear breakout, especially to a new low, traders will trail those stop. Instead of putting the stop up here, they'll put it above the most recent major lower high. For example, we have a breakout here and follow through. This is probably a major lower high, even though we did not get to a new low of the bear trend. It's reasonable by the close of this bar to tighten your stop here. It's probably better to wait until we break out below the prior low and then use that stop. But this is, at this point, by the close of this bar, a fairly major lower high. And if the bears are in control, the market should not get above this high. This high is the neckline of a double bottom. And if the market rallies back up, reverses this bear breakout, and goes above the neckline of the double bottom, you're probably no longer in a bear trend. And you're selling because you believe it's in a bear trend, not in a trading range. If it goes above a major lower high, then it's not a bear trend. It's either a trading range or possibly a bull trend, and you should get out, even if it results in a loss. Strong bear breakout, good follow through, more follow through. If the market's in a bear trend, it should not get above this high. Should you trail the stop down here? While you could, it's still probably slightly better to keep the stop at the top of the bear swing instead of just the top of the bear breakout. But again, if the bears are in control, chances are it'll not get back above the top of this sell climax once it got somewhere down here. Bear trends need lower highs and lower lows. Without them, the market's not in a bear trend. The lower highs are especially important, especially major lower highs that lead to a resumption of the bear trend, a strong bear breakout, and a new low. If the market keeps getting major lower highs, then the trend is still good. If it gets above a major lower high, then you're either in a trading range or in a bull trend. And if you're selling based upon the premise the market's in a bear trend, and you get evidence that you're wrong, you just get out. Just take your loss. I talked about different ways to sell. I want to talk a little bit more about that again. Strong bear, breakout, good follow through bar, good context, parabolic wedge, failed breakout above a triangle. You can start selling closes. You can sell that close, this close, this close. Some traders will sell more than one, adding to the position, and very few traders will sell every one of those closes, but they'll only do that if the total position size is small enough so that they can use the appropriate stop. As soon as the bar closes or right before the bar closes, just sell the market. I said you could place a limit order to sell at the close of that bar, but sometimes you will not get filled. In a very strong bear trend, like here, this bar never went above the close of that bar, and therefore a trader taking that sell, placing a limit order at the close of that bar, did not get filled, and he missed the trend. Again, it doesn't matter how you sell, you have to get short, and you have to take at least one entry. Some traders will take multiple entries and add to their position, but you have to take at least one. And the easiest way is, as soon as you see a strong bear close, you just sell the market. Some traders, as I said, will sell bear closes and sell more with each consecutive bear close. And at some point they get disappointed and they start trying to get out around the low close. Sell the close bear trend, disappointing follow through. A lot of the bears will sell more higher and then try to get out when the market comes back down near that bear trend. So they get out, break even on their first short, if this was their first short, and then they get a scalper's profit on the higher short. And they get out here, and you can see that big move up. It went down again, but it went up sharply. A lot of that is bears buying back shorts at the low close. Some traders just pick any short, any reason to sell, rely on the stop, and swing trade, and stay short until there's a reasonable reason to expect a trend reversal or until the end of the session. I talked about some traders just scaling in, adding to their winning trade, increasing their position size, but they can only do that if the total size of their position is still small enough to use the appropriate stop and small enough so that they're comfortable and can make objective decisions and not worry. Why do you think these bars are all closing on their lows? It's because institutions are selling right before every bar closes. They're selling all the way down, and especially right at the close of the bar. They're willing to sell on the low because they believe the market is going lower. And if the institutions are doing that, it's reasonable for us to do the same. One reason why traders sell on the way down, selling at the market, is the market may go very, very far before there's any pullback. Some traders are afraid to sell at the close or sell at the market. They want the pullback. But you may end up missing a lot of the trend, a lot of a very profitable, high probability trend. And it's usually better to try to enter early, and that means selling at the market. However, some traders only want to sell pullbacks because then the risk is smaller. Again, once you believe it's always in short, it's usually good to sell at least a small position, and selling at the market is a good way to do it. Some traders, when they start out, want 100% certain that they're going to make money. They want a perfect trade. But usually the best you're going to get is 60% certain. And if you're going to be a trader, you can't be frozen by the 40% chance of losing money. You are going to lose money sometime, but 60% is as good as it gets. So if you're a trader, place the trade. Again, if you cannot decide how to do it, and if you find yourself waiting a bar or two after you believe the market's going down, just sell at the market and use the appropriate stop. For example, it doesn't matter if you sell this close or sell anywhere in here, this is where the stop goes. We have a bear trend, we have a pullback, and you can sell on a stop below that bar, betting that the profit taking that came down here will end soon and the bear trend will resume. But if you do sell that low one or this low two or this bigger low two, your stop is still up here. Low one, low two, or a bigger low 1 pullback and a bigger low 2. It's also a wedge bear flag, 50% pullback. Another low 1, we have a bear breakout of a wedge bear flag, and we have a pullback, so that's a low 1 sell. Reasonable to place a stop order to sell below the low of that bull bar. We have a bear inside bar, and if you want, you can think of it as a low 2. We have a bear breakout, a low 1, the bear trend trying to resume. We have a pause, we have an inside bar here. You can sell below the low of this bar a second time that the bear trend is trying to resume. If you want, you can think of this as a breakout to a new low and a pullback from the breakout. That tail is the pullback. So if you want, you can call it a low 1. Doesn't matter what you call it. You simply have to understand that the bulls were trying to create a reversal and they're failing, and the bear trend is probably going to resume. So the bulls are trying to reverse up once. They're trying to reverse up twice with this tail, and both times they're failing, and you have to get short where the bulls are giving up. If you take these shorts, reasonable to use a tighter stop just above the top of this bear breakout. The same is true down here. We have about a 10-bar bear microchannel, a pullback. Even though we have a bunch of dojis, it's reasonable to sell on a stop below that bar. It's a low 1 short and a bear trend. Probably the best the bulls get is a trading range for 5 or 10 bars and not a bull trend. And it's possible the bear trend continues down quite a ways and you can make a lot of money. Triangle. We tried to reverse up and we went down, up, down. A triangle and a bear trend usually becomes the final bear flag. However, it's reasonable to take the sell because it could fall quite a ways before the failure occurs. If you remember on the earlier slides, this was a triangle and the bull breakout went up a lot of bars before the failure occurred. Here we have a triangle at the bottom of a bear trend, and this breakout could go down pretty far before it reverses up. In this case, it did not. We got a micro double bottom. We went down and up on that bull bar, down again, and then up again here. Again, choose any entry, and you know where the stop has to be, and simply rely on your stop. Early in a trend, the market tends to form a low 1 and then resumes down. As trends mature, as they get older, as they continue for a long ways, the pullbacks tend to get deeper and you tend to get low 2 or low 3 pullbacks. Here we have a very strong trend, and right away the first pullback is a wedge, a low 3. And here we have a bear trend, the first pullback is a low 1. But as trends progress, they tend to have more complex and deeper pullbacks. When you're in a strong bear trend, you have to assume reversal attempts will be minor and become bear flags or trading ranges and not bull trends. And therefore you can sell bull closes, betting the reversals will fail. Again, I said you could sell above bars, and you can sell above a prior high. We have a high here. Traders can sell with a limit order at the high of that bar. A lot of traders like to sell a 50% pullback. They'll place a limit order to sell at a 50% pullback, or they'll sell using a stop on a reversal down from the 50% pullback. Some traders like to sell a fixed number of pips up. For example, if you're day trading on a 5-minute chart, you might sell a 10 or 20 pip rally above the low, again using the appropriate stop. Strong bear breakout, another strong bear breakout. If you're selling and the market is having a strong breakout, it's usually better to swing at least part of your position and use the correct stop. If you sell for any reason here, your stop is up here. After the market resumes down again, your stop is up here or here, and the same with here. And it's good to swing at least part of your trade because the trend could go very far. For example, if you sold here, the market did not reverse up until maybe 40 bars later. Some bears will use a very wide stop and hold short until the market is clearly always in long, or until there's some reasonable buy signal, like a major trend reversal buy setup. The market's still always in short at this point, but we have a failed breakout below a triangle, we have a double bottom, and we're starting to convert into a trading range. We have a micro double bottom here, down, up, reasonable to take profits here, betting that the bear trend is probably converting into a trading range, and you might get a strong reversal up, maybe to the breakout point here. A double bottom and a micro double bottom, and a bull bar closing on its high. A failed breakout below a triangle. You can call it a wedge, 1, pullback, 2, pullback, 3, pullback, and now we have a double bottom, testing the wedge bottom. And we're around a measured move down from the original breakout. The open of the first bar, close of the final bar, measured move down is in this area. So there are several reasons for bears to take profits and for bull scalpers to start buying. You can see the bulls who bought this low made money. Bulls are starting to make money with limit orders buying below bars. They might start to make money with stops buying above bars. Reasonable to get out here. If you did not exit here, at this point we have 4 or 5 bull bars and a pretty tight bull channel, probably going up higher, reasonable to get out here. It's still in a very broad bear channel, and the odds are this is going to be a big minor reversal, not a major reversal. However, the potential is for the market to go higher, and the reversal will be strong enough so that the next reversal attempt could be major. A major reversal usually follows a strong minor reversal. Take final profits, maybe a breakout above the triangle. We have a very tight channel. We have a micro channel, no pullbacks for about 6 or 7 or 8 bars. Most traders would get out before there. Most traders would be getting out as the market's converting into a trading range down here. At this point, the market's probably always in long, and computers would start buying. You would start buying, and it would be good if you get out of shorts first. Most traders do not like to reverse. However, since it's reasonable to buy here, it's certainly reasonable to buy back your shorts. So if you're thinking that if I were flat, I would go long, if instead you're still short, you have to buy back your shorts. This video is about bear breakouts, and I emphasize the importance of stop management. It's very important to use a reasonable stop and to trade small enough so that if your stop is hit, you do not lose more than you would on any other trade. And there are many ways to sell. The easiest one in a strong breakout is simply to sell at the market and trade small enough so that you can use the appropriate stop. You can also sell pullbacks, bear flags. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on trading breakouts.